Okay, hi, welcome. My name is Brian Leni. I'm the founder of JuniorStockReview.com. For those of you who don't know me, I'm an engineer by trade. I worked 10 years in the steel manufacturing industry, first as an engineer on the floor and then in management. And then in 2016, my portfolio went up around 300%, and I left my career in steel to pursue investing full time. And now I write about what I invest in. Resource sector narratives. Many of us hear a lot of narratives in this sector, whether it be gloom and doom in the gold market or the EV battery market. And narratives or storylines that draw your attention to certain metals. And I think a distinction needs to be made between the metal and the resource company. If you like the metal or you're bullish on the metal, buy the metal. Junior resource companies are speculations on people and their ability to push a company forward, regardless of the underlying metal price. However, if you can align a good management team with the upswing in a metal price, the results can be spectacular. So today I'm going to talk about nickel, a short and long-term outlook. But for me, I have a bullish outlook, and it's based off three main factors. And the first is stainless steel demand. The second is falling global inventories, and the third is the burgeoning EV market. Stainless steel demand. If you're bullish on nickel, you need to be bullish on stainless steel. As you can see in the pie chart, stainless steel represents 2/3 of nickel demand, and over the last 30 years, stainless steel demand has grown by around 50%. And personally, I don't see that slowing anytime soon. So there's four main factors or usage for stainless steel in the global market. And the first is heavy industry. And this is power generation, both renewable and non-renewable. You have transportation, trains, automobiles. And third, you have construction, bridges, piers, any type of public infrastructure. In particular, coming from the steel manufacturing industry, I've got some experience with stainless steel's kind of migration into infrastructure. Just before I left my job, 50% of the product mix that we made at our rolling mill was rebar. And we had a global within North America team that looked at where the market is headed. Specifically the southern states, Florida, the Carolinas, Louisiana. They're pushing not only towards longer lifespans for their infrastructure, but implementing higher and higher grades of steel within this to get those lifespans. And it was kind of comical, as one of the team members said, the amount of nickel and stuff that we have to add to this rebar, you're almost making stainless steel. So the stainless steel is making an influx into the construction market. I only see that segment growing in the future. And then the fourth is consumer goods. And whether it's for appearances or for longevity, consumers want stainless steel goods for their appliances, their utensils, their cookware. Global nickel inventories. So this was a big thing. Back in 2016, I started looking at nickel and trying to decide where I thought the market was going. One of the biggest hurdles that I saw was global nickel inventories. And if you look at the table on the left, you can see that we started up around 500,000 tons globally in LME, Shanghai, and bonded warehouses. But we've seen a great decline, especially over 2018, where the nickel inventory is sitting at a very healthy level, I think, around 200,000 tons. And I think we need to watch this going forward, as it just shows a more bullish sign trending downwards. The clean air movement. So we talked about narratives. I think next to the gloom and doom of the gold market, the clean air movement is probably the biggest. And the clean air movement, ties in with the energy metals. I break it up into two components. The first, it deals with pollution. And there's three main metals that I've seen personally where it's affected. This is nickel, zinc, and iron ore. Iron ore probably being the best example of this. There's a bifurcation between your, let's say, regular grade and your high grade material, where the high grade is getting premiums of 25 to 30%. And in really, I think that's going to come to the nickel market at some point, where Class 1 nickel is given a premium over the rest of the products out there. Glencore estimates that 182,000 tons were removed from the market over the last 3 years. For perspective, it's a 2 million ton market, so this represents roughly 9% of the global market that's been removed due to pollution concerns. The next point, politics. We live in a global marketplace. Policy, environmental or political policy, mainly environmental, has a huge impact. Indonesia and the Philippines are two of the countries that have the largest impact, considering they represent around a quarter of the global nickel market. And you can see the quotes at the bottom, in particular from the environmental minister from the Philippines, stating that 23 mines were closed over that last year, and that's 2017. It's without a doubt that it has an impact, on the global market. So the second part to the clean air movement is EVs, and there's kind of three components to it. So the first are cash incentives. Governments around the world, you can see China, the States, Japan, are incentivizing their citizens to purchase EVs. And conversely, they're also penalizing. And those of us in Canada are very familiar with the carbon tax and what that could mean to oil prices and really any carbon emitting appliance in the future. The second part to that is, in terms of nickel, is when you look at battery chemistries, the two most popular battery chemistries for EVs moving forward, NMC and NCA, have large nickel components. And this nickel component is projected to get even higher as cobalt prices have remained high over the last few years. So now we get to the Class 1 nickel market, and there's definitely a tightening of supply in this, and we see it with the drawdown in inventories. The specialty steel makers and the battery makers have already started to have this proverbial tug of war for the Class 1 nickel, and that's what's drawn down the inventories, and that's where I see a large impact to the nickel market moving forward. Glencore estimates with a 30% adoption rate by 2030. This is in terms of capacity would be 1.1 million tons. The fact that the whole global nickel market is 2 million tons, adding roughly 55% in demand over the next 10 to 11 years, without a doubt has an impact. You sort of wonder, where is this production going to come from? So 2017 was a great year for the nickel price. I don't know if most of you may have seen it. It's one of the best performing metals. However, in 2018 it took a real step back. And there's a couple of reasons why I think that is. Interest rates and the trade war. So first, interest rates. Not only were interest rates raised over the last year, but they were raised at twice the frequency, which I don't necessarily think feeds into affecting the nickel market, but I think it brings enough uncertainty to the global marketplace that it created a perfect storm for the U.S.-China trade war to take center stage and kind of put a cloud over the entire base metals sector, nickel being one of the effects. So this is something that we need to watch in 2019. So this was a big announcement last year. This Chinese company announced a $700 million project for a 50,000 ton per year HPAL plant in Indonesia. You might be asking yourself, well, why would one plant impact an entire sector? Well, there's two main points. First is cost. $700 million for a 50,000 ton per year operation translates into roughly $14,000 per ton. By historical standards, you can see in the table, this is magnitudes lower than what historical plants have been constructed for. And really, at $14,000 per ton, puts them at the top end of the first quartile of nickel producers. The impact of having a cost profile like that, moving forward would be very impactful. Now, you might be wondering, that's a large range, 50 to 90,000 tons in CapEx dollars, and might be wondering why. There's a number of different reasons. There's no mine that's the same, but one of the big things is the actual composition of the nickel laterite deposit. You'll see in the image, it's sort of a stratified layering of minerals, and you have limonite on top and spiralite on the bottom. And you'll see in the chart in particular, there's one that you think you have to, in terms of how it affects HPAL, you have to look at the MgO content. And so MgO has a neutralizing effect on sulfuric acid, and sulfuric acid is the acid used in the HPAL process. Therefore, the higher the percentage of MgO, the worse it, or the most underperforming the HPAL process will be, or the more costly it will be to actually liberate the metals. The second component to that, and what some of the companies are relying on these days, are the high cobalt contents. So if you have a high percentage of cobalt, and you're able to recover that cobalt, it can offset that cost to the nickel, and may prove to be a point in the future for HPAL plants. So just remember, basically, limonite, or a high percentage of limonite, means low MgO, which is good, and a negative is high spiralite, and that means high MgO. And yeah. Construction timeline. So this is another impactful point. So they say that this plant is going to be constructed by the end of 2019. And again, compared to historical standards of these HPAL plants, this is extremely quick. Bring your attention to Valley's Goro, or the VNC mine now. It took 3 years to construct, and a further 6 years to reach 60% of nameplate capacity. And then you've got Sherritt's kind of debacle in Madagascar, where it took 4 years to construct and a further 3 years to get 80% nameplate capacity. You know, these things are extremely complex and costly, and for me, this is why I have a lot of doubts that they'll be able to attain this very aggressive goal by the end of this year. However, if they are successful, this is definitely something as an investor I think you need to contemplate. If they are successful, considering that laterites make up 70% of the world's nickel resources, it would be, you know, not catastrophic, but it would almost completely dampen, in my mind, the impact of EVs in the future. And if you can feed Class 1 nickel at $14,000 per ton, you know, a lot of these sulfide projects that are economic, $9 and above, they probably don't get made or constructed. So concluding remarks, I think this year will be an interesting year, you know, for all metals, nickel in particular. I think we need to look at the Fed announcement coming up in March, and not in terms of how it affects nickel, but more how it affects everything, and the uncertainty of the world in a rising interest rate environment. Second, I think resolution between the US and China would be fantastic for base metals, nickel in particular. And we need to watch for progress reports as, you know, Tishan's HPAL plant progress is, like I said, could have a major effect on the entire market. And then finally, looking long term, we need to see continued inventory drawdowns. This is a very bullish trend for me, and something that makes me even more confident than I was before of nickel's future. And finally, if you're bullish on nickel, you're bullish on stainless steel. So you want to see continued progress or demand from stainless steel market. So my nickel pick. For me, I'm invested in one nickel company at the moment, and it's FPX Nickel. And the investment thesis starts with the CEO, Martin Turenne. Martin is a very smart and motivated CEO who is progressing his company forward regardless of where the nickel price is. There's three main components to an improved PEA. The first is optimized metallurgy, which was already pretty good, but they're in the process of optimizing that for a higher recovery rate. Second is an improved exchange rate between US and Canadian dollar from their 2013 PEA. And the third is in 2017, they did an exploration program where they stepped out from the existing deposit and identified what is the highest grade ore that they've come across so far. And that should be a starter pit when this thing actually does get constructed in the future, which is good for NPV appreciation. And then here's a list of some of my other picks of companies that I like that I've bought during tax loss season just a few weeks ago. And then one final comment, be picky. There are a lot of companies out there, but in my opinion, very few of them deserve the attention of the investor. So be picky, and good luck. Thank you.